The Statement of Financial Position of Champion Partnership as of January 31, 2020, when Chambers and his partners decided to liquidate, is shown below. We have the accounts cash, other assets, accounts payable, loan due to Onofre. Note that this is a liability, not a receivable, because it's due to, not due from Onofre. Chambers Capital, Piamonte Capital, and Onofre Capital. The partners share profits 30% to Chambers, 40% to Piamonte, and 30% to Onofre. The creditors and the partners are paid as cash becomes available. From this sentence, we learn that this is about liquidation by installment, because payments to outside creditors and to the partners are made in installment. Information about the sale of the other assets follow. We have the carrying value of the assets sold, the cash proceeds from each sale, as well as the liquidation expenses paid in February, March, and April. So this confirms that the problem concerns partnership liquidation by installment, because the non-cash assets were sold not once, but by installment. By the way, from the term itself, liquidation expenses are obviously those incurred by the partnership in relation to the process of liquidating the business, or in order to facilitate the immediate sale of its non-cash assets, such as advertising and commissions given to salesmen or referring agents. Prepare a statement of liquidation with supporting schedule or schedules of safe cash distribution, or alternatively, cash priority program, and journal entries assuming the partners are solvent. Notice here, schedule or schedules, because depending on the problem, one or more schedules of safe cash distribution may be needed. In this video, you'll learn how to do the schedule of safe cash distribution. The cash priority program, together with the journal entries, will be covered in part 2. Let's start now the statement of liquidation. Not to forget, of course, is the heading. Name of the business, statement of liquidation, and the date of liquidation. Next, we use the given accounts in the statement of financial position of Champion Partnership as our money column headings. The problem states, the partners share profits 30% to Chambers, 40% to Piamonte, and 30% to Onofre. Let's place those on the capital column headings. Then, let's write the balances before liquidation from the balances given in the problem, eliminating 3 zeros from each figure to have enough space for the presentation. What's the first step again when we are already doing the statement of liquidation? Realization or sale of non-cash assets. But please keep in mind that we need to do things chronologically. February 1st. Other assets with carrying value of 360,000 were sold for 225,000 with no liquidation expenses paid. Was there a gain or a loss on realization? Loss, because the cash received from the sale is less than the carrying value of the asset sold. So, realization and distribution of loss, or we can describe it simply as sale of assets at a loss in February. Deduct 360,000 carrying value of the asset sold from the other assets and add the cash proceeds to the cash account amounting to 225,000. The loss of 135,000, that is 360,000 minus 225,000, decreased the capital balance of each partner. For Chambers, 135,000 loss times 30% equals 40,500. Same for Onofre, who shares profit and loss 30% also. For Piamonte, 135,000 times 40% equals 54,000. Balances now. Since there was no liquidation expense paid in February, our next step must be to pay the outside creditors. Can the partnership afford to pay this entire 675,000 worth of accounts payable? No, because it does not have enough cash. But since the outside creditors enjoy priority of payment over the partners, the business should use this entire 585,000 cash available for partial payment to the creditors. However, let this be clear please. It is permissible for the partnership to pay the outside creditors an amount less than the cash balance of 585,000 pesos in case it anticipates possible future liquidation expenses. But it must ensure that the cash withheld will not be distributed to any of the partners because the outside creditors enjoy payment priority over the partners. But since in this problem, it is not mentioned that the partnership withheld a certain amount of cash, then this cash balance of 585,000 should be used as first installment payment to the creditors. When the business pays, both the cash and the accounts payable balances decrease by the amount of the payment. Balances again. Notice there is zero balance already in the cash account of the partnership. To have cash again, some more of the other assets will have to be sold. And that happened again the following month of March. 450,000 pesos worth of other assets were sold for 540,000. Was there a gain or a loss? Gain this time because the cash received exceeds the carrying value of the asset sold. The gain of 90,000 increased the capital balance of each partner according to profit and loss sharing ratio. Determine the balance of each account now. Before payment of the remaining accounts payable, don't forget that in March, there were liquidation expenses paid amounting to 45,000. The liquidation expenses paid is better shown first before the payment of the accounts payable and immediately after realization, because as mentioned earlier, this most likely was incurred for the partnership to be able to sell the other assets. And like loss on realization, liquidation expenses decrease the capital of the partners using, again, their profit and loss sharing ratio. Balances again. Next, after payment of liquidation expenses is the payment of accounts payable. The remaining accounts payable amounts to 90,000. Should the partnership pay this entire amount? Yes, because it can afford to do so, its cash balance being greater. But let's say Champion Partnership wants to pay only 80,000 accounts payable instead of 90,000. Is that allowed under partnership law? Yes, for as long as the difference, which is 10,000, 90,000 minus 80,000, will not be paid to any of the partners. But since nowhere in the problem does it say that Champion withheld cash from outside creditors, then it follows 90,000 was paid due to the fact that the partnership can very well afford to pay it. So, upon payment, decrease both accounts payable and the cash by 90,000. Again, get the balances. Notice, there is no more outside liability, but there is still some cash remaining. So, what's the next step? After paying off all the accounts payable, distribute the cash to the partners. But the problem here is the cash of 405,000 pesos is not enough to pay all of the partners' interest. So, how are we going to distribute the cash? Using the partners' profit and loss sharing ratio? Of course not. The cash is not profit or income or loss or expense. The ratio is not called cash sharing ratio. That's why we cannot use that ratio to divide the cash among the partners. It is called profit and loss sharing ratio, meaning we only use it to distribute gain or loss, such as the gain or loss on realization or absorption of a partner's capital deficiency, or expense, such as liquidation expense, or when there is expense adjustment to update the partner's capital, or income, such as in case of revenue adjustment or revaluation of assets. We must not use that profit and loss sharing ratio to divide the cash for the payment of the partner's interest. Instead, we have to prepare either a schedule of safe payments or a cash priority program to determine who must receive cash payment and how much a particular partner must receive. As mentioned earlier, in this part 1 video, I'll show you how to do the schedule of safe cash distribution. The cash priority program will be discussed in part 2. The starting point of the schedule of safe cash distribution is the partner's interest, consisting of their capital and loan balances prior to the cash distribution. Then, deduct what is called restricted interest A partner's restricted interest is the portion of his interest which cannot be paid yet because it must remain with the partnership in order to absorb possible future losses. Recall that the partnership still has other assets remaining with carrying value of 990,000. The first restricted interest, I said first because there may be another, it depends, concerns the possibility that these other assets may not be sold anymore. I am not saying that the remaining assets will not be sold anymore, but no matter how slim the chance is, just in case nobody would buy them anymore, what then would happen? That would be considered a loss, that the partner's interest would decrease. That's why the restricted interest can be described as possible loss of 990,000 if nothing is realized out of the remaining assets. By the way, this possible loss is often referred to as theoretical loss, the as-if loss of the partnership. The possible loss of 990,000 pesos is then divided among the partners using their profit and loss sharing ratio. 990,000 times 30% equals 297,000 to Chambers and Onofre. 990,000 times 40% equals 396,000 to Piamonte, all with open-close parentheses to emphasize decrease. Balances now. Now, please pay close attention to this. In case the partnership withheld a certain amount of cash for possible future liquidation expenses, that cash withheld will be another restricted interest, which will decrease the interest of the partners according to their profit and loss sharing ratio. But since the problem does not say that the partnership withheld a specific amount of cash, then we do not have restricted interest for possible future liquidation expenses. But does it mean that we are already done with our schedule of safe payment? Notice, there is negative balance in Piamonte's interest. That signifies we are not done yet with our schedule. And therefore, we need another restricted interest. But this time, the restricted interest is about the possibility of loss to Chambers and Onofre if Piamonte, the deficient partner, will not pay. Now, you may want to ask me, doesn't the problem state that the partners are solvent? So why the absorption of the deficiency? The answer is, even so, this second restricted interest does not say that Piamonte cannot or will not pay. We just have to anticipate or be prepared just in case Piamonte, for whatever reason, will not pay. That's why notice the word if here. In the same way that we had anticipated the possibility that the other assets will not be sold anymore. Both restricted interests are just made in view of the conservatism principle or the convention of prudence that possible future losses be anticipated. In short, when doing a schedule of safe cash distribution, the solvency of a partner does not matter. As long as his interest becomes deficient in the schedule, we always need to have restricted interest, showing the absorption of the deficiency by the other partners, just in case the deficient partner will not pay. Please remember that. Going back here, how will this deficiency of Piemonte be absorbed by Chambers and Onofre? Since this is a possible loss, we need to use the profit and loss sharing ratio of Chambers and Onofre. 30% for Chambers, 30% also for Onofre. That means what? They must share in the absorption equally. So, 162,000 deficiency of Piemonte divided by 2 equals 81,000 between Chambers and Onofre. Balances now. Notice something? There is no more deficiency in any of the partners' interest. That means our schedule of safe cash payment ends here. This row is called free interest, meaning the portion of the partner's interest that can be freely returned to them. 45,000 must be paid to Chambers, while 360,000 must go to Onofre. And please note that when we add this 45,000 to 360,000, we get the sum of 405,000, which is exactly the amount of cash available for distribution. When that amount is paid to the two partners, the cash, of course, decreases. 45,000 payment to Chambers decreases his capital. As for Onofre, since the partnership has a loan payable to him, the 360,000 payment to him is first applied to that loan, not to his capital. Moving forward, get the balances. Now that the other assets remain as the only assets of the partnership, naturally, those assets would have to be sold to realize some cash in order to pay the partners again. And that sale occurred in April. All of the remaining assets with carrying value of 990,000 were sold for 450,000. So, the other assets decreased by 990,000, while the cash increased by 450,000. There was loss distributed among the partners using their profit and loss sharing ratio. Balances again. What's next now? The payment of these liquidation expenses amounting to 45,000, which resulted in a decrease in the cash balance as well as in the capital of each partner. 45,000 times 30% equals 13,500 for Chambers and Onofre. 45,000 times 40% equals 18,000 for Piemonte. Balances once more. With no more outside liability, no non-cash asset to be sold any longer, and no capital deficiency, the final payment to the partners can now be made. according to their capital and loan balances, without the need for another schedule of safe cash distribution. In other words, a schedule of safe payment is made only when the cash available for distribution to the partners is insufficient or not enough to pay the entire amount of the partner's interest. When this 405,000 pesos cash is distributed, the cash account decreases. 90,000 goes to Onofre for the partnership's loan due to him, with another 112,500 for the return of his capital. Chambers receives the balance of 202,500 in payment for his capital, after which each account has zero balance because the partnership is no more.